Very good morning, friends. In today's period, we have to study the next topic, that is capitalization. What is the title of this topic? Capitalization. What is the exact meaning of capitalization? We have to understand. Capitalization is, try to understand, capitalization is one of the most significant area of financial management. The term capitalization The term capitalization cannot be precisely defined. The meaning has to be arrived at by the context in which the term is used. One meaning of capitalization is that it consists of stocks and long-term debts outstanding. Okay? In general, the term capitalization refers to the total amount of capital employed in business. Try to understand. Very simple concept is there. The term capitalization refers to the total amount of capital employed in business and includes the sources from which funds are made available for a relatively longer period of time. Okay, this is called capitalization. Okay, now we have to understand different types of the definitions which are given by the different thinkers. First definition is given here, Goodman and Dougal define. They define capitalization as the sum of the par value. Capitalization as the sum of the par value of the outstanding stocks and bonds. This is the definition given by these two fellows. Then next definition is also given here. A.S. Deving, he is going to say that the term capitalization includes capital stock and debts. Very simple definition. The term capitalization includes capital stock and debts. Okay. Then Husband and Dockery, they have also given the definition. The ordinary meaning of capitalization is the computation, appraisal or estimation of the present value. The ordinary meaning of capitalization is the computation, appraisal or estimation of the present value. These are the definitions. Then another definitions also we have to understand. Gerestenberg says that capitalization comprises of the company's ownership capital, which includes capital stock and surplus in whatever form it may appear, and borrowed capital, which consists of bonds or similar evidences of long-term debts. Okay. Then from the above definition of the capitalization, it appears that the term overstock and bonds and their computation, appraisal and estimation. It means that from the above definition we can understand the concept capitalization. It appears that the term overstock and bonds and their computation, appraisal and estimation. It means that the concept capitalization we have to study. In other words, the term capitalization includes not only the quantity of the capital but also its quality and composition. Quantity is also important, but quality and composition is also important. Now we have to understand what are the aspects of capitalization. There are three types of the aspects of the capitalization. First aspect is the amount of capital. Second is composition or form of capital. And the third is change in capital. Okay. What is it? Change in capital. It means that we have to understand the capitalization of corporation. We have to study the capital structure of new and old enterprises. One of the problems faced by the financial manager is that the determination of value at which a firm should be capitalized. Accordingly, the funds can be raised. There are two important theories or basis that contains guidelines with the help of which the amount of capitalization can be determined. Okay. Now, what are the theories of capitalization? Those theories of capitalization also we have to study. There are two theories of capitalization. First theory, cost theory, and second, the earning theory. Now, we have to understand the cost theory. The historical cost theory, try to understand. The historical cost theory considers that capitalization is the equivalence of the cost actually incurred on the setting up of the corporation. The total value of capitalization is calculated by taking the total cost. The total value of the capitalization is calculated by taking the total cost of acquiring fixed assets and current assets. The amount of capitalization is based upon original out-of-pocket investment in the plant, equipments, etc. In the real situation, the amount of capitalization for a new business is arrived at by adding up the cost of fixed assets, the amount of working capital, and the cost of establishing business. For example, fixed assets are of the 75 lakhs. Preliminary expenses are 75,000. Working capital 5 lakhs. And the total of the capitalization you will find 80 lakhs 75,000. Thus, the amount of capitalization for the company would be, what is it? 80 lakhs 75,000. The company has to raise this money by issuing securities. Okay? Try to understand. And this cost theory also we have to study. What are the merits of this cost theory? We have to understand now. The merit of this cost theory or cost theory you have to understand. It is based on actual expenditure. Try to understand. This theory based on actual expenditure and not on any forecast or anticipated expenditure. So considered more reliable. That's why this theory is more reliable. This theory has not been considered different biases or different basis of capitalization. This theory has not been considered different basis of capitalization on the following grounds. First, it takes into consideration only the cost of the assets and not the earning capacity of the investment. Then second, earning of the companies fluctuates when the assets becomes obsolete or idle. This cannot be detected if capitalization is made on the basis of cost. It is not suitable for those companies where the earnings are irregular or varying. It may lead to overcapitalization. Okay? And the second theory we have to understand, the earning theory of the capitalization. According to this theory, a firm should be capitalized on the basis of its expected earning. The worth of companies is measured by its earning capacity. Profit or earning capacity are the basis of capitalization. What are the basis of capitalization? Profit or earning capacity of the organization. Now, value of the company is equal to value of its earning. This is the equation. What is it? Value of company is equal to value of its earning. Earnings are capitalized at the representative rate of return. Earnings are capitalized at a representative rate of return. And capitalization is equal to annual net earning into capitalization rate. In this way, this earning theory of capitalization also we have to understand. Now, with the help of the following example also, we can explain more detail. Okay? If a new company estimates that its annual average earning will amount to the sum of rupees 1 lakh. What is the annual average earning? Rupees 1 lakh. While the companies in the similar industries are earning at the rate of 20% on their capital employed. The amount of capitalization for the company would be capitalization is equal to annual net earning into capitalization rate. Annual net earning is given here rupees 1 lakh and capitalization net earning rate, what is it? 20%. It means that rupees 5 lakhs. What is the amount of capitalization? Rupees 5 lakhs, that is the amount of capitalization. Now, what are the advantages? we have to understand the advantages of this theory, earning theory. First advantage is there, this method calculate the value of company. Try to understand. This method calculate the value of company directly with its earning capacity. This is the first advantage. And the second advantage we have to study here, that is it acts as a check on the cost of establishing new companies. It means that such type of a check is also there, and that is also possible on the cost of the establishing new companies. These are the two advantages of the earning theory of the capitalization. Now, second side of the coin we have to study here, that is the disadvantages. What are the disadvantages? First disadvantage you will find there about the earning theory of the capitalization, that is the process of estimating earning for a new company is very difficult. It means that it is not a too easy job to understand, to estimate the earnings for the new company, and this type of limitation also we have to understand. Then second disadvantage or limitation we have to understand, an error committed at the time of estimating the earning will be directly influencing the amount of capitalization. If any error will be there, that error directly influencing the amount of capitalization. And the third disadvantage we have to understand here, there is an element of uncertainty. There is an element of uncertainty in capitalization rate as it fluctuates with the phases of business cycle. It means that there is an element of uncertainty. Everywhere you will find uncertainty and uncertainty. And in capitalization also you will find uncertainty and capital rate as the fluctuations. And such type of fluctuations you will find with the phase of business cycle. Now, the concept fair capitalization we have to study. What is the meaning of fair capitalization? Fair means not a more, not a lower. Okay. Such type of a capitalization is called fair capitalization, not a excess or not a less. Okay. Such type of a capitalization is called fair capitalization. Capitalization is always governed by the net earning of the enterprises. The amount of capital should be in tune with the earning capacity of the company. Again, the capital of the company should be represented by its productive assets. The overall objectives of business firm is achieved only through proper mobilization and use of funds. The securities and the size of capital have to be properly selected to maximize the wealth of the company. Therefore, fair capitalization is essential. It means that you have to understand why fair capitalization is essential to avoid the demerits or to avoid the limitations of undercapitalization and overcapitalization. You have to understand the fair capitalization. You have to understand the fair capitalization. Try to understand. It means that fair capitalization is essential. Okay. Then for the example purpose, I have given here balance sheet. For the example purpose also, I have given here balance sheet, and in that balance sheet also you will find the liabilities. Equity capital rupees 10 lakhs, debentures 20 lakhs, current liability 10 lakhs, and in asset side also you will find fixed assets 30 lakhs and current assets 10 lakhs. With the help of this balance sheet also you will understand. The above illustration, the debt equity ratio is 2 to 1 and is said to be ideal to exploit the financial leverage benefit. The long-term funds are used to meet long-term capital expenditure for acquiring fixed assets. Short-term funds are properly invested in current assets, so it can be fair capitalization. Why it is called fair capitalization? Try to understand. The long-term funds are used to meet long-term capital expenditure. Long-term funds are used for long-term capital expenditure for acquiring fixed assets. And short-term funds are properly invested in current assets. So it can be fair capitalization. When you can say this is a fair capitalization, if this situation you will find there, at that time you can say This is the fair capitalization. In the above illustration, the debt equity ratio is 2:1 and is said to be ideal to exploit the financial leverage benefit. The long-term funds are used to meet the long-term funds are used to meet for what purpose? Long-term capital expenditure for acquiring fixed assets, and short-term funds are properly invested in current assets. So it can be fair capitalization. In practice, it is very difficult to attain such ideal situation due to the various internal and external factors. Try to understand. In this way, the fair capitalization concept is also over. Now, if any difficulty is there, you can ask me. Okay? Thank you. Thank you very much.